Hello, in this lecture we're going to work some variance analysis. We will be focusing in on the overhead section, looking at the overhead spending and efficiency variance and the fixed overhead spending and efficiency variance. So in order to do this, we're going to take our data here, we're going to plug some numbers into the data, focusing in on the things that will affect the overhead in specific. So we got the direct labor being important because oftentimes we calculate overhead using some estimates from direct labor. So I'm going to say direct labor, we have the 7 hours times the $7.30 per hour. And the thing that's important is we're using that 7 hours to allocate the overhead, both the variable portion and the fixed portion. So we're going to do the same thing here. We're going to take that 7 hours, which again doesn't have anything to do with the actual labor in terms of overhead. We're using the labor in order to allocate overhead using the rate of $4.50 for that allocation. This is the standard cost for a single product. And then we've got the factory overhead being the 7 for the fixed side times the $7.60, our allocation method. And we could sum these up, and I'm just going to sum the overhead portion. So I'm just summing the $31.50 and the $53.20. So that's kind of the data that's generally given here so that we can then use that data, basically our estimates per unit. We also have the estimate for the flexible budget information. So this is the estimate for one particular unit. This is the estimate flexible budget information based on capacity. So as capacity changes, we want to basically make different estimates or set our budget up in such a way that we can make different estimates so that we can make an actual comparison to what actually happens in terms of the same capacity level. So we have the 70% capacity, the 80% capacity, the 90% capacity, and we're making predictions in terms of budgeting that on these different levels of capacity in terms of production in units, standard direct labor hours, and then we have the budgeted overhead on the fixed factory overhead and the variable factory overhead based on these different production levels. Okay, then we're going to look at what actually happened, and this is also going to be given here. Then we know the month has ended, you're imagining the month has ended, and we know that we actually produced at 70% capacity, and the units produced were actually 40,600, and the actual direct labor hours were 282.8. We know that, and so we're going to compare what actually happened to what would budgeted to happen based on the same capacity level, based on the 70% capacity level, because that's what actually happened. So we have the same number of units produced. Of course, the standard direct labor hours will differ, which means our allocation for the overhead, which was based on the direct labor hours, will differ as well. So let's go down here. We're going to take a look at the standard cost assigned, and then the actual, and compare that to the actual costs incurred as we go here. So then we got the direct labor in terms of the standard. The direct labor in terms of the standard at the 70% capacity is this 284,200. Again, that's important in terms of the overhead because we use that number in order to help us to allocate out the overhead as well. So for the variable factory overhead as well as the fixed factory overhead, we're going to use this same number because that's what we use in order to do the allocation. So then we're going to use our numbers in terms of this first worksheet, standard costs for single product. And we said that we're going to have the 450 at the overhead for the variable. And we said that we were going to have the 760 at the fixed overhead. All right, so if we multiply that out then, we're going to have the 284,200 times the $4.50. We have the budgeted 1,278,900. Then we're going to take the 284,200 times the 760, giving us the budgeted for the fixed portion of the 2,159,920. If we sum those up, then we're going to add those two up. That's our total just for the fixed and variable portions of the overhead. Now, once the time has passed, we're going to actually know what happened in terms of overhead, meaning we know what the direct labor is at that point in time after it's over, and we know the actual costs. We at least know that much. So we know the variable factory overhead, the fixed factory overhead. We could determine, we may have to determine the cost per unit based on that information, based on the relevant term that we used, which was the direct labor. So we know what the direct labor hours are, and we know what the totals are. So let's see if we can back into basically the cost per unit in terms of what actually happened, and that would be a division problem. We say the total divided by the number of hours that actually happened means that we had the 435. That would be our cost per unit. For the variable factory, we're going to do the same thing for the total divided by the direct labor hours, and we get the 851. So we can then compare these differences here. If we looked at the total differences, we'd say, okay, this is the total difference of what we thought was going to happen minus what actually happened in terms of total dollars. And we can also say this equals what we thought was going to happen in terms of the fixed factory overhead cost minus what actually happened. And we can then sum up the differences here. There's our total. Now basically we're going to break out this number. We're going to break it out into its components. So we have the total here. We're going to break it out into the two components. So we're going to be down here, and we're basically going to recalculate these end numbers first. So the actual hours, I'm going to say the actual hours are this number. And the actual rate then, I'm going to say for the variable costs are going to be this number. And if we multiply those two out, then we have the 282.8 times the $4.35. And of course, that ties out to this number here. We're going to do the same thing on this side. We're going to say this times this. So we've got the standard hours. Standard hours are going to be here. I could take it from any of these three. Obviously, they're all the same because they're based on the direct labor. And then we're going to take the standard rate, standard variable rate, and that's going to be this number here. And then if we multiply those two out, I'm going to make these green too, because this is going to be the main numbers. We're going to say the 284.2 times the 450, and we have this matching this number, so we just recalculated those. And of course, if we just took the difference between these two, then that's going to be the same here. I know I reversed the sign, but it's the same thing there. And then we're going to break those out into the components. So we'll start on this side. We're going to highlight these four items. These four items are what we're basically looking at. So we're looking at this times this, and then this times this. So we have the actual hours times the average rate, actual hours times the standard rate. So the thing that's changing here is the standard rate. So the actual hours, we're still saying those are over here. Here's the actual hours. And then we've got the standard rate, however. The standard rate is the thing that's being different. That's going to be over here. So that's what we're focusing in on. I'm going to go ahead and add some decimals there to make that. Okay, so now we have the 450 versus the 435. That's what we're comparing the difference of, because this number is the same in both calculations. So if we multiply that out, then we have the actual hours times the standard rate. And if we were thinking about it, we would hope that the actual rate would actually be less than the standard rate, because that would mean that we got a better rate than we budgeted for, and that would be a favorable difference. So if we subtract these two out, I'm going to say this equals this number minus this number, and that's going to give us the favorable difference. Now if we go over to the other side, I'm going to unhighlight these and go to the other side, and we're going to say 1, 2, 3, 4, highlight these on this side. And what we are going to be comparing is this times this and this times this. So that's our comparison now. And so we have the actual hours, the standard rate, and then we have the standard hours by the standard rate. So what's different? It's the hours. So now the hours are different here, hours are different here. The rate is the same. So we're focusing in on that difference. And once again, we would hope that the actual hours are actually less than the standard hours, the budgeted hours, because if they are, that means that we did it in less hours than we think, and that's the case here. So we're going to say this equals this number minus this number, and that's going to be the favorable difference. And so they're both favorable in this case. So if we take the 42,420 plus the 6,300, now that we get back to our original number here. So we take this number, we broke it out into its components here and here, so that we can focus more on those components. What are those components? Variable overhead spending variance. That's going to be this number. And of course it is favorable. I'll make it a capital favorable. And then we have the variable overhead efficiency variance is this number. And it too is favorable. And then we've got the total here is going to be the sum of these two. The total overhead cost variance. And it is, of course, variable, and that's going to be the total that if we just subtracted the two out, we would get to here. All right, so I'm going to hide a couple of these, and we're going to do the fixed overhead spending variances. So I'm going to highlight this. I'm going to highlight down to, how about here, right-click and hide. We're going to do a similar process, but now, of course, we will be focusing in on this number. So we're going to do the same starting point where we're looking at this difference, and we're comparing this number and this number. So we're basically going to recalculate these two numbers, this number and this number. And then we'll go from there. So we've got the actual hours. So we're going to say the actual hours are over here. There's the actual hours, and we're using the same actual hours for both the variable and fixed portions. And then the average, the actual fixed rate. The actual fixed rate is going to be this 851. There we go. And if we multiply those two out, then we're going to have the 282.8 times the 851, and we've basically calculated this number. We'll do the same thing over here. We're going to say, okay, here's the standard hours. Standard hours. Again, I put them all here. You can take any one of them. It's fine. They're all the same number. And then we're going to take the standard fixed rate, and that's going to equal the 760 in this case. And if we multiply those two out, we got the 284.2 times the 8, and I'm going to make that add some decimals there. Add decimals. There we go, 760. And then if we subtract those two out just to check this number, I'm going to say, okay, it's this number minus this number. We have the same number here. Again, I reversed the signs here, but same number there. Then we got the budgeted fixed overhead. So I'm going to say this equals, and take it up to the budgeted fixed overhead number, where we had the budgeted fixed overhead to be the 2,468,480. And that's what we're going to compare it to in this case. So we're going to take this equals the 2,468,480 minus the 2,406,480. That gives us the 62,000. And on this side, we are going to take equal the 2,159,920 minus the 2,468,480. That's going to give us the 308,560. And then we're going to move down here and we're going to say the fixed overhead spending is going to equal the 62 tab, and that's favorable. We're going to say the fixed overhead volume variance is going to equal the 308,560. That is unfavorable. And then we're going to sum that up, and we're going to have a total unfavorable here. Okay, so if we sum up the overhead controllable variances then, and of course, just to point this out, obviously this then adds up to this number here, this total difference there. So now we're going to sum up the overhead controllable variances. In order to do that, I'm going to unhide. So notice we have 24, 25, 38. So we're going to unhide there. So I'm going to highlight from anywhere up here down past that funny point and right click that area and unhide. And then scroll back down to where we're at, and we have the variable overhead spending variance. The variable overhead spending variance was calculated up here, and that was favorable. And then we have the variable overhead efficiency variance. The variable overhead efficiency variance was calculated up here, and that was favorable. And then we have the fixed overhead spending variance. That's going to be right here, and that's favorable. And then if we sum these up, we get the total overhead contribution variance equals the sum of these there, and that is favorable.